Yeah.
Yeah.
Okay.
Okay. Yeah. And let me start with oil and gas first. Uh,
Okay.
because we recently they have the analyst meeting for oil and gas operator, so they kind of give the view on the in each in each segment. For example, in terms of the oil price in the second half, they expect that the oil price should be softer compared with the first half. The average first half is about almost 72 US dollar per barrel. Quarter to date is about 70 in terms of the oil price. This is because they believe that the oil price should be softer after a higher OPEC plus supply from the unwind production cut and also the economic slowdown. Based on the OPEC plus policy, actually they have like the volunteer production cut since the year 2024, and at that time they have a volunteer cut by 2.2 million barrel per day. And right now, starting in this April this year, they changed my mind in order like to regain their market share, and then they just like adding up the capacity by each month. And right now they expect to raise another 545,000 barrel per day in next month, and they will have like a total 2.2 million barrel per day after they have a volunteer production cut since early last year. So production is coming back, and also non-OPEC plus also ramping up their production as well. So that's why they think that the oil price in the second half should be softer than the first half. And in terms of the petrochemical product, in terms of the refinery, of course, should be a bit in quarter to date is a bit uh, softened because of the low season. Quarter to date for the Singapore GRM is about 4.1 US dollar per barrel. Compare with the uh, compare with what to say the sorry, compare with the number. The number in the second quarter is about 5.6 US dollar per barrel. They think that the Singapore GLM should be a bit better in the fourth quarter, but the third quarter is a bit soft. So we think that GRM for the refinery will will be pressure the refinery performance in the third quarter. And for the petrochemical, of course, oversupply remain still. And even though that I mentioned in this morning, even though the Korean government plan like to have a production cut, but it seems that it should not help much in terms of the petrochemical price and spread. So that's why uh, we think it is hard like to for us like to how to say to pick the petrochemical petrochemical stock as our topic. So our topic will be more uh, the one that related to the domestic play like PTT oil and retail, or the ticker is OR, and also the stock that related to the packaging business. That one the demand is still there, so we still like SCGP and also IVL. For IVL, the third quarter is always the second or the third quarter always the peak quarter for the company. And for SCGP, it's gonna be like the fourth quarter. Yeah, I'm stop here for any questions.
Just a question on GRM. Has
Yeah,
that been more volatile these days? Because I don't remember in the past GRM is so volatile.
yeah,
Is that correct? Mm.
yeah. For the GRM is
Yeah.
really quite volatile, up and down all the time.
Yeah.
But normally, second quarter should be good, and fourth quarter should be good. I mean, late
Mm.
fourth quarter to the early of first quarter, it should be good.
Okay. But I mean, correct me if I'm wrong, but these days, right,
Mm.
the the
GRM.
volatility is a
Yeah.
lot more, and it can like range from very low to very high.
Mm. If you compare with first quarter and the third quarter, I think the range uh, in the third quarter is like short, smaller than that we seen in the first quarter. If you can recall, in the first quarter is like sometimes it's like 0 point something,
Yeah. Uh,
yeah, the
mm,
dollar per barrel, and sometimes it's high to like 3 to 4 at that time. But
mm,
for this is about 4 plus or minus.
mm. But I'm what I'm trying to say is in the past, right?
Mm, yeah,
Um,
yeah, 7
it,
sometimes is
yeah,
11, 12. Yeah,
yeah,
right.
much
But
better. Like
yeah,
maybe like 10 years ago, for example. So I'm just
oh,
wondering why is that the case?
this is because of they adding the new refinery capacity, and
Oh,
it
so
and
just that.
next year will be like the last cycle for adding up the refinery capacity, new refinery capacity. Next year is the last year on the in the cycle, and the year 2027,
Oh,
where the demand will over the demand addition will be much more than supply addition.
mm. So
Yeah,
you're saying that the supply has gone up a lot over the years, is it?
yeah, yeah,
Over
that's
the
correct.
years.
Yes, yes.
Oh,
Yeah, we have
because of
like
supply. Mm.
yeah, because of the fire supply new refinery.
And mainly
So
from
many.
China, is it?
Some China as well, but for this year they have
Oh.
some refinery from Mexico and and Nigeria, if I'm not
Mm, mm,
wrong, the big one.
okay. Okay. So, but going forward, would that, so you're saying the supply should slow down, is it? Going forward, let's say in 3 years, in the
Oh,
next 3 years,
of course.
or there's still expectation of,
Yeah,
increasing supply.
next year will be the last year for like that. We will see the supply addition will be more than the demand addition.
Oh,
But the later on, it will be demand over the supply.
why is that the case?
Oh, uh, I I believe that because of they foresee like the weak in the GRM, that when you build the plant you need like to decide like 3 to 4 year ahead of the new capacity, 3 to 4 year
Mm,
ahead of your construction, because
okay.
you need like to do the EIA, environment assessment and
Oh,
everything. So it's, for example, like Thai oil, if they didn't like delay, it is about 5 year ahead of the previous plan that they want the refinery to be installed.
oh, okay. So you don't, there is so far nothing much in the horizon in
Mm-hmm.
for the next 3 years, like, is it? in terms
Yeah,
of plant
that's right.
construction.
Yeah, yeah.
Oh,
Next
okay.
next 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 year, based on the information that we got from Thai, or that they always tracking, next year is a bit oversupply, but later on will be like over
Mm,
demand. Yeah, we have that graph, and we already like
okay.
put in the paper. And if you would like to have that graph, we can send
Uh,
it to you in the
okay.
in the WhatsApp.
Okay.
Yeah,
Okay, that'll be interesting. Okay.
yeah,
Thank
yeah,
you. That's all I have. Yeah.
yeah. Okay. So maybe let's move to bank and finance. Thank you.
Okay, I will start next with the banking and finance sector. I will start with banking first. In second quarter, bank earning beat our expectation by 16% and the market estimate by 7%. The key reason is the investment income, which surpassed our forecast and our early and conservative, um, raising our credit card assumption to respond to the effective of U.S. tariff. However, given the current investment condition, we do not expect further material investment gain to be reported in the second half of this year. Therefore, we expect the net profit for the banking sector to soften in the second half of this year compared to the first half. For the policy rate, Bloomberg consensus forecast the policy rate to be 1.25% in first quarter of 2026. However, uh, local investor and many Thai research house expect the policy rate to be 1.25% by the end of this year. Therefore, we have factored in 1.25% for our policy rate assumption. For the second half, we remain concerned for the increase in credit costs and weakening asset quality due to the worsening economic outlook. So we maintain market weight for the banking sector, and our top picks are KBank and KTB. For the reason why we have seen BBL and SCB perform quite well, one of the reason is I saw the number, the foreign ownership increased quite sharp for the BBL. Despite the policy rate cut outlook will pressure for the BBL about the NIM and for the loan yield. Okay, I stop here for question for the banking sector.
Okay. So you're trying to, so should people be taking their profits on BBL if they bought into the so-called rally?
Yeah, my view is
Mm.
that is correct because I think BBL should not go so far from here. Yeah, we have
Oh.
seen the coming up of the foreign, but for the outlook for the fundamental, we should
Mm.
see a NIM weaken soften half
Yeah.
on half due to the rate cut.
Okay. And overall, which banks will see worse off in terms of credit costs, which you say is a concern?
For the credit card,
Yeah, which ones are worse? Which banks would see worse credit costs
yeah, okay.
increase?
Give me a minute, please.
Okay.
Okay. For the credit cost, I think if we mainly in the for the small bank, which are TTB, Tisco, and KKP for the
Mm.
increase in credit costs. But for the big bank, I mean for the full bank,
Mm.
I expect the increase in credit cost Q on Q, quarter on quarter, over quarter.
For all of them, is it?
Yeah, for all of them.
All will see higher credit costs
Yeah,
quarter on quarter.
yeah.
Okay, but slightly lah, right? Not
Slightly,
alarming.
not alarming yet.
Oh,
But
okay.
as I mentioned in the early of this year that we expect the continuous reduction in credit cost that I very confident that a bank will perform well due to the positive outlook. For now, we have changed the view that okay, it will not continue to continuously reduction, but we will see slightly increase quarter by quarter.
Okay. So not as great lah, like if that's what you're saying, is it the outlook? Because
Not much,
of
not great.
not as good as what you thought before,
Yes,
because
correct.
going forward there will be some worsening of credit costs.
Yes, correct.
Okay, and then also like you say, the non-interest income will not be so strong, is it? Because lower investment gains.
Yes.
That is the other reason.
Yeah, and the point you have ever point to me that how the Thai bank can raise the non-interest income, such as the fee, to compensate the lower yield. I think for the current, I think the Thai bank cannot raise the fee to compensate. Just investment gain to compensate and to support the bottom line. But the first half, some bank realize investment gain and some bank mark-to-market gain. So I think for the second half, they will not report any more significant for the investment income. But just only Kung Thai, as I said in the paper, that they will mark the gain, yield gain from Thai Airways in the third quarter.
Okay. Okay, understood. Okay. What else should we look up for the banks? How about K-Bank? K-Bank, the Gulf has stopped accumulating, right? They have been buying it in the market
before, but
they have stopped, right?
They stop and they realize gain and reduce the exposure.
Oh, they actually sold some, is it? They actually cut some exposure.
Yeah.
Wow.
They cut to only, I think, 3 or 4% from previously almost 5. Yeah. The government management previously mentioned that they invest in K Bank for just a return and dividend, and then we saw that GAP already sold K Bank share.
And they made money.
Yeah, they made a huge money. Huge money.
Wow.
Yeah.
Okay. But the share price still seems to be holding up, you know.
Yeah, for the whole banking sector.
Yeah. Okay.
It's quite contrast from my view that we should see a softened share price because of the policy rate outlook that will negative for the bank. But we have seen that the share price keeping up. Yeah.
Okay,
but I think it will not go so far from here.
But after a while, deposit rates they will actually adjust down, and that will help them soften the pain on the weaker NIM. Is that happening already? They should actually do that, right?
For the deposit rate, they not really. I mean, not adjust much for the deposit rate.
But why not when the lending rate has been lowered?
Because for the rate high cycle, they not increase much for the deposit rate. So that's why deposit rate they keep it quite low for a long time. Since the policy rate high cycle, and for now, it's not change much for the deposit rate. But a bank will benefit from the debenture rate for the new issue. Yeah, the cost cost of fund will lower from the new series,
Oh,
new rollover, new rollover series for the new lower cost.
mm, the debenture. Okay.
Yeah.
Okay, got it. Thank you. That's all.
Okay. And a short brief for the consumer finance. We have 5 stocks in our coverage. We recently add BAM to our sector. And we foresee the majority of finance companies are likely to miss this year loan growth target. Such as MTC, they report 6.4% year-to-date loan growth versus 10 to 15% for the target. Yeah, I think that they will miss the target. And for the other 2 operators, they report contraction loan growth year-to-date. So many management from many finance company, they say that they prefer slower loan growth or maybe loan contraction to people more than to grow the portfolio, and they prioritize secure good asset quality and stabilize credit costs. So we should see all of them miss their this year loan growth target. And for the asset quality, for now, all company they guarantee and said that the asset quality is under control, and they're not concerned about the outlook for the asset quality. But from my view, as I have mentioned for the banking sector, I concern that we might see an increase in credit cost and for the weakening asset quality in the second half due to the impact from the US tariff and weakening economic outlook, and for the maybe instability for the politics in our country. So we maintain market weight for the finance. Our top picks are MTC and KTC. So I stop here for question.
Sorry, your topic is MTC and
And
which
I
one?
add KTC Kung Thai
Oh,
Card.
okay.
Yeah.
That one got hit badly, but you said oversold, right, that time?
Yeah.
Yeah,
Correct.
okay. But
I think
yeah, good.
we remain have upside for the KTC.
Okay. Okay, overall your call on this sector has been good, so well done for this one.
Okay, thank you.
Okay.
Sorry.
Okay, thanks. No other questions. Thank you.
Okay, that's all from banking and finance sector. Move to next, please.
Hi, Doreen. Moving to the retail sectors. Just a quick recap on the second quarter that the retailers post a slight negative same-store sales, mainly driven by the weaker of the purchasing powers and the uneven cooler summers in these years. And this impacted the home improvement retailers the most, as a Home Pro was the hardest hit. And the consumer staple like CPR and BJC saw only mild decline, while the Com7 was, which is an IT retailers, was the only players that posted a positive same-store sales, thanks to the resilient demand for the IT products. One positive sign is that we can see an improving across the board in terms of the cost management. Companies are working to reduce the expense and enhance the efficiencies. And as a result, only CPR and Com7 was delivered a positive earning in the second quarters. Looking ahead in the third quarter, we still expect the same-store sales to stay in a slight negative. Based on our check, the quarter-to-date same-store sales still was improving, but still negative due to the ease of the weather impact. The Home Pro same-store sale remain mid-single-digit negative. The BJC is also still expected to be a negative low single-digit, but better than Home Pro. CPR stay flat. And Com7 starting to see traffic coming back following the launch of the new smartphone model. Breaking down into the categories, that the consumer stable demand continue to show a resilient. Fresh food sales remain a positive key driver for the grocery retailers. And on the store expansion, Home Pro and BJC decided to delay some new branch opening, while the CBR and Comsmen remain confident to pushing ahead of the expansion. Even the earning growth in the third quarter may not be exciting, but we still hopefully that the hope is improving for the earning in the fourth quarters. First, the renovation of some hypermarket will be completely, and which should improve the store traffic and improve occupancy rate in more business or like BGC and CPO. And the second, the tourism should be picking up during the high season, which should improve the both of the store traffic and the ticket size. And the third, the government initiative that the government trying to push the domestic consumption, which the details should be clearer by then. And moreover, the lower the policy rate should be like benefit the retail sector in terms of the consumer confidence. We also positive on about the cost initiative, with the retailer trying to push several cost down strategy, such as the expanding the high margin private label contributions, focusing more on the high margin ready-to-eat product, which is a high margin products, optimizing the market expense, utilize headcount, and also the lower electricity cost should be better in terms of the second half of this year. All of these should be supported margin in the second half and later on. Overall, the current valuations are attractive, trading about like 14 to 15 times PE, which we believe that already priced in the most of the negative factors. And our top pick is CPR, supported by the resilient consumer stable demand and further market share gain at the 7-Eleven. And I stop here for any questions.
On the same store sales growth, right? Does that actually translate to better earnings for those that see positive same store sales growth? Does that really have that kind of positive impact at the end of the day?
Yeah,
So
yeah.
I'm just wondering the correlation.
You mean the correlations of the same store sale and earning, right? Or the share price?
Earnings.
Okay, when the same store sale growth should go slight negative or negative, it's resulting in the SG&A comparing to sales to increase because all the retails in Thailand, they quite have an operating leverage with SG&A. The part of SG&A is a fixed cost. So since the SG&A was going down, it quite hurt the bottom line. So in many like retailer, they're trying to cost down and trying to reduce the expense to maintain an SG&A to sales. And come at the CPR, even they have the same store sale growth negative in the second quarter, but they could maintain SG&A to sales because they're trying to down their expense to maintain SG&A to sales. So this is the manner that many retailers trying to do in the second half of this year.
Okay.
Yeah.
So basically, not just same store sales growth that is important. Of course, the cost lah, right?
Yeah, in my view, it should be the cost is one of the but the market like trying give prioritize to the same store sales growth because it is the it's quite significant more than the cost in my view. So that's why the share price of the retail sector is very very on demand currently. But I think it's time to invest in my view.
Okay, so whenever they announce the SSSG numbers, the stock price will react, is it? Do you see that?
Oh, actually, they did not. They will announce the same store sale growth when the earning was announced. But for the retailer analyst, we call to the management to channel check about the same store sale growth, and we trying to communicate to investor in every month. So this is one of our is one of catalysts that we're trying to communicate.
Okay, that's the right way I would say.
Yeah.
Okay. Okay, so not much of a change in your view lah. CPO and Com7 are still
Yeah,
your
correct,
picks,
Victoria.
Okay. But I mean, like like what we were saying, right? I mean, what we have been expecting, softer economic conditions.
Uh-huh.
Would that weaken the outlook for these two even?
Actually, if we looking in the quarter, as I mentioned, that quarter three same-store sale in the third quarter,
Yeah.
it's still the pace of the same-store sale is quite similar to the second quarters, which is like slight negative. So if the economic condition do not do not worsen, the bottom line shouldn't be changed in my view. So CPO, which is the grocery retailer stock, which demand quite resilient and quite defensive comparing to like the home retailers, should be deliver the earning in the second half, and we think that our earnings forecast did they have less chance to revise down in my view.
Okay.
Mm.
Okay. All right. Thanks.
Okay, thank you, Doreen.
Yeah. Thank you.
So moving to the next, please.
Hi, good afternoon. Moving to the property sector. According to previous analyst meeting, all developer anticipate gradual recovery in the residential market from the second quarter. However, they all express that they remain cautious about the market. And in my opinion, despite positive factors such as real estate measure or rate cut, we anticipate a challenging recovery path. The residential market will continue to face multiple headwinds, especially a low purchasing power and tightening bank policy. Even the high-end segment, they has witnessed intensify competition, and developers are expected to continue focusing in inventory liquidation. So we expect the pressure on cost margin for an extended period and do not anticipate for a swift or rapid recovery in the cost margin. Regarding earning outlook in the third quarter, we expect developer will continue to report mixed results following the backlog and the upcoming handover of condo project, but the margin is remain relatively low. And however, we remain cautious about the pre-sale momentum, which is significantly behind their target of accounted for only 30 to 36% of the total target, which put downside risk to earning visibility and potential revision down earning forecast from the market. So we maintain the underweight rating for the sector to observe the market recovery clearly. I stop here for the property sector for any question.
So far, right? Have you? I mean, like in terms of gearing, how have the ability to service the loans for the property stocks? I mean, they have not really been able to launch many products, right? Most of them, and I'm just thinking how are they going to, if they do not have they don't have many launches, and even with launches, they don't really sell so many. So how are they going to, service their loans?
Okay, about the project launch. For our project launch in this even the next year we will see a lower and lower because the profile the pre-finance for the launch project is quite tight and require more qualification for any project to launch. Maybe then they require more than a 40% take-up rate for the new project launch, which is quite hard for this market condition.
Yeah, so
And the
so
next
I'm just I'm just worried that I'm just thinking, you know, how can they service their loans, right? Construction project loans have maybe, you know, maybe the bank's side we can get some insights. So far, have any of them have problem in servicing their loans for property
Yeah,
construction
it's just
related?
some. Yeah, just it's quite different between the market leader and the loser. If we look at the LPN, they are quite hard to get loan for launching project. But
LPN.
LPN, yeah, LPN development,
Mm.
yeah, and or when the origin property. But if we look at to the market leader, they is still confident in the financial
Oh.
statement, and they
Mm.
can access the project loan or the bond to issuing the bond. So they
Mm.
expect to continue to launch any for them for their project.
When they launch bonds, right? What kind of yields are they offering?
Yeah, I will show that if we look at the solid performance company like AP and Supply, they get quite the competitive rate about 3%.
3% only.
Yeah,
They
3%.
could.
But
Wow.
yeah, but if we look at the origin property or LPN development, they got the rate about more than 5%.
Hmm. I see. Okay, but so far nobody has problem servicing their loans. Is that right?
Yeah, that's right.
Okay. Okay. If you are to rank them, which ones will be most at risk?
For that risk, yeah, for me currently, I'm see as the origin property and LPN.
These two most at risk,
These
correct?
two,
Mm.
and another one is I think the Puxa Holding, but they're quite continue that diversify the portfolio. So I think it's maybe they have a fewer list compared to the first the origin property and LPN.
Okay. Okay. I think that's an important thing to watch out for in terms of them, in terms of servicing the loans. And yeah, I mean, you look at the Chinese names, right? You can actually see when they first start to be not able to service their loans, and then or even service the bond payment,
Yeah, I have
everything
seen
will
that
start
in
to
the Chinese
unravel.
market.
Yeah. So yeah, keep us informed. Okay,
Thank
I think
you.
that's all the
And
questions I have for your sector.
okay, and move to the next sector is the construction services sector.
Mm.
Let's begin with in terms of the earning outlook. Key contractors such as the CK, Chao or Staycon are expected to maintain healthy core operation in the second half of the year. A solid backlog is expected to underpin their construction revenue, and while gross margin will be supported by a favorable revenue mix. However, the result in the third quarter are expected to be mixed. Staycon is projected to experience a quarterly decline in earnings but year-on-year increase, and CK is likely to experience a year-on-year decline and both year-on-year decline and Q-on-Q due to the share of profit investment and equity income, which expect to lower because their CK is expected to have a benefit, lower benefit from the FX gain. And if you regarding about the new order in this current year, Staycon had significantly outperformed or outpaced CK. Staycon has already secured more than half of its target, while CK had not signed any project in the first half of this year. And overall, and that is the situation, but we should keep an eye that about the political instability as well, that potential to delay public project bidding in this year. Okay, and overall, while we remain optimistic about the core operation, we are cautious about the political instability and potential delay in public project bidding. So we maintain market weight and we select stay on for the potential to secure new order from both the private and public sector compared to its peer. So I stop here for any question.
So you have a buy on Stacon. How about CK?
Sorry.
You have a buy on Stacon, right? But how about CK?
I recommend for both. For Stacon and CK, my rating is in buy for both.
Oh, buy for both.
Yeah,
Okay,
but I prefer the Stacon.
Okay. You mentioned earlier that Stacon has managed to secure some new contracts in the first half.
Yeah. More than half already secured, and they also expect to sign more project from the private sector.
More
So
than half
then
of their target, is it?
50 billion baht in this year.
Okay, and that's actually more from the private sector, is that right? Or mix?
Actually from the private, mostly from the private sector.
Yeah, because the public ones have not been really been
it's
launched,
quite
right?
quite delay and not really no any project release in the first half.
Zero for public, yeah.
Yeah.
Okay, so CK has not secured anything year to date, is it?
Correct. Yeah, they just only expect to sign only one project this year, that the double deck project that we have mentioned before.
Okay. Yeah, in that case, I'm not sure about CK though. I mean, between the two, right, which one is more dependent on public/government projects?
CK actually definitely Shao Kan Shang dependent on public project.
Okay. Yeah. So why do you have a buy on it unless you're sure that the government projects will come up?
Yeah, for CK, for the reason that I am recommend buy for the CK, two reason that for the we are optimistic about the cooperation for the CK. The revenue remains strong and cost margin. And for the second reason is that the undemanding valuation or cheap valuation, because the share price is decreased significantly since from the audio leak about the prime minister.
Sorry, what did you say again? The what leak again?
First reason is about we are optimistic about the core operation of CK. Yeah, but about the revenues, visibility and the cost margin remain healthy above 7%, is quite above average. And the second reason is about the cheap and valuation or undemanding valuation, just for two reasons.
Okay, but the current backlog, how long can it last them? Let's say if they don't see any contract
for CK, CK backlog is stored about 190 billion baht. Actually, it's quite remain healthy or remain high, because this is supposed to be support the revenue stream about 4 years.
Oh, can last for 4 years based on the recognition of revenue.
Yes.
4 years. Wow. Okay. Just no catalyst in that sense. Okay. Understood. All right. Thanks.
Okay.
Oh, sorry. How about Sorry, how
Yep.
about Stack-on? Stack-on, what's the backlog?
The backlog is second backlog stood about 120 billion baht.
Oh, lower.
Yeah, lower. But there are possibility to gain more
Mm.
to more contact compared to the CK.
Who has higher margins?
CK short CK has about almost 8% for the gross margin, and Stacon gross margin is about 7%.
Oh, just slightly lower.
Yeah, just slightly low.
Okay. Thank you.
If
Yeah,
there are no
thanks. Good
more
call.
further question, that's all for me. Thank you. Moving to the next person.
Thanks.
Hi, Robin. The next one is the update on the food sector. I will begin with the result recap. The livestock payer reported record high earnings in the last quarter as expectation by the higher swine price from the ASF outbreak, together with the lower raw material price and the export sales still growth. And for the second half outlook, we expect the livestock payer earnings to soften half on half, pressured by the decline in the domestic swine price to be around at 74 to 76 kilo baht per kilo, down 10% Q on Q. This is in line with our view that the swine price are in a downward trend due to the partial recovery in the supply. And although the major Thai swine producers have signed an MOU to slow expansion for the next 2 years, which should help reduce price volatility, but it could only partially offset the impact from the weaker demand. Nevertheless, we don't expect the swine price to rebound to higher levels similar to the second quarter at around 88 baht per kilo. And in terms of the raw material price, we expect the raw material cost to continue soften in the second half. That could partially offset the downtrend of the swine price, supported by both year-on-year and half-on-half declining in mainly from the soybean meal, and expect to see the upside from the U.S. import corn will have the lower price than the domestic corn price. And for the other topic, we still like the GFPT the most due to the lower downside from the swine price downtrend, and expect the margin improvement for more portion of the processing export and the lower raw material price continually in the second half. In addition, we still call buy on the TFG as we expect to see the development of the earning in the second half, following by the growth state of the core business from the retail shop in the domestic market. The TFG continue to expand its retail shop with a target revised up to 620 stores in this year. And they also expand the soy business to the Vietnam market and plan to invest the feed and the chicken business as well. So we maintain the market weight on the food sector, and our topic is the FPT. So I'm stop here for the question.
Sorry, prefer GFPT to TFG or?
For the topic, we like GFPT the most because as the domestic swine price is in the downtrend, and GFPT they do only the chicken. Yes, and they will get the directly benefit from the raw material cost comparing to the swine producer like CPF, Behago, and TFG. They may face the downside from the downtrend of the domestic swine price. So I think that CP growth will be get to the GFP than the swine producer. GFPT, sorry.
Okay, but how's chicken prices been?
For the domestic chicken, it will be around 40 to 41 baht. But comparing the chicken pie to the swine pie, the chicken price will be stable than the swine pie. But in terms of the gross profit margin, they will be get more higher of the GP because we don't see any downside from the chicken price. So in the export side, we expect the CPT get more portion of the processed food that can generate them for the higher gross profit margin.
Okay. Okay. Okay, thanks. Got it. Thank you.
Okay, and the next one is the quick recap on the media sector. For the second quarter, the TV player and the cinema operator experienced a year-on-year earning decrease. The year-on-year earning decrease from the TV player like 1E and BEC was mainly due to the declining in the TV advertising spending and underperform of both Thai and the Hollywood film for the major. But in the out-of-home media player like NB, they report that year-on-year and the Q-on-Q earning growth. This growth was primarily driven by its out-of-home segment as the leader out-of-home assets in the Thailand. And for the third quarter outlook, the TV player expect to see the Q-on-Q recovery in the advertising spending due to the launch of the new content. But nevertheless, the earnings still decline year-on-year due to the shift in the ad budget to the other media platform, especially in the digital media. And for the cinema operator, we expect the third quarter earnings should drop Q-on-Q from the low season, but expect to see the increase year-on-year from the better performance of the Hollywood movie and the low base from the last year. And in terms of the out-of-home segments, it's expected to deliver both Q-on-Q and the year-on-year growth, supported by capacity expansion and the seasonality of the advertising demand in the second half. Additionally, Plan B will benefit from the transaction with the VCI and the Halo LED in the second half. So we maintain Plan B as our top pick given its leader position in the Thailand out-of-home media and the lower disrupt risk comparing to the traditional media like 1E and the BEC. So I'm stop here for the question.
No questions on this. Thank you.
Okay. So I'm moving to the next, please.
Hi. So afternoon. So I've got I'll go through with the healthcare sector first, which I'll call still the market weight. And there are like two main factors in the third quarter. So the third quarter will not be like a typical high season that as it should have been in like many years when the rainy season starts. So this year's influenza outbreak has already happened in the first quarter. So the figures of the outbreak in July and August is quite low if we compare year on year. And also the second factor is the Thai-Cambodian conflict, which should be pressuring the top line for all operators. And with these two factors, the operators that rely on Thai patients like BDMS and BCH will likely to be pressured in the third quarter. And yeah, it's mainly contributed by the first one, which is the lower high season than it should have been. So that's why BH would be a standout pick in this the third quarter, as it mainly relies on foreign patients, mainly like the Middle Eastern. So if we rank them, it would be BH, then BDMS, and then BCH. So I stop here for questions for the healthcare.
But for BH, right? They haven't really been doing well them. I mean, like they are dependent on more foreign patients, right? And that's not really been strong also. So why would I mean
So
sounds like sorry, go ahead.
yeah, just the tone has shifted slightly because For last year in the first and second quarter, it was when the Kuwait patients was still referred to BH. So the base of the revenue is quite high. So that's why their revenue in the first quarter and the second quarter of this year has been declining year on year. Yeah. So yeah, and also this first quarter, it was also affected by the early Ramadan, if you remember. And also the second quarter, there was the impact from the earthquake, which caused a slower return of the foreign patients. So yeah, in the third quarter, according to the management, they are saying that they are seeing quite a strong recovery in the Middle East patients. And also the third quarter last year also didn't have any Kuwait patients revenue. So yeah, we should able to see be able to see the revenue to grow year on year for the first time in like 2 or 3 quarters. So it's quite a turnaround compared to the others where they are facing a top line pressure from both the Cambodian conflict and also the lower high season.
Okay, so you're saying that BH for the coming quarter will be better than the other two.
Yeah, that's my view.
Year on year. How about Q on Q?
Q on Q, for BH, they should improve Q on Q as well, and quite tremendously as well, because the second quarter this year is quite a low base, caused by the earthquake, and also they got some revenue intensity drop as well. So yeah, Q on Q they should be up quite a lot. For BDMS and BCH, I would say it would be quite flat Q on Q for both of them, but for BCH they should drop Q on Q from if you could remember that there is like an extra revenue that they recognize every year, and for last year it was recognized in the third quarter, but this year it was recognized in the second quarter. So that's why, if we compare this year's third quarter to last year's should be like a very high base. So we should see quite a substantial decline in the earnings in the third quarter for BTH. Yeah.
Oh, sorry, what's this special
So
earnings?
it's like an annual review of the 26 chronic disease, which is like an annual review that happens every year. So and it should have been booked in the third quarter, but this year's came quite early. That's why I think the market has already quite priced in already, as you have seen. Yeah, the share price has dropped quite tremendously for the past few days, mainly because of this concern that the third quarter that they should see quite a substantial earnings drop.
Year on year.
Yeah, year on year.
Okay, so they recognize this special earnings in 1Q or 2Q already, you said?
In second quarter this year.
2Q, the results.
2Q. Yes.
How about the rest? Do they have this kind of special earnings recognition?
It's pretty much tied to the social security. So the others have very low exposure to this, so it doesn't even matter.
Okay, that's why. So weird. They have this kind of special earnings recognition. I don't understand really.
Yeah, that's why it's quite complicated when you have to deal with the organization related to the government.
Yeah, but could it be a negative impact as well?
Not really, because these kind of
always
reviews
underpay
are like,
you, is it?
Yeah, these kind of reviews are like, if I have to explain to you, patients are being admitted, for example, for his heart disease, But when he's being treated, they might find out that, oh, in fact, this guy got some problems with a stroke or a neural system as well. So they are being diagnosed additional disease in process, and that additional disease will be recognized by these kind of annual reviews. That's why it's keep popping up every year.
Oh, so they need more treatment than actually.
Yeah. That's
So
why
it's
the Social Security will underpay them at first, and but then they have to revise and
okay.
review this kind of treatments, and
BCH.
pay
Okay,
them more.
understood.
That's the concept behind this.
I see. Okay, got it. Thank you. That's all. That's all I have.
Okay,
Thank you.
so then I go to the hotels, and we still maintain the market weight as well. And the whole picture in the third quarter should be pretty much similar to the second quarter for all operators, just with a slightly better seasonal recovery of Chinese. So typically in July and August, the Chinese should be recover Q on Q. But still the pace of recovery is quite slow. So it's still like 40% below last year's pace. And yeah, most of the operators' tone are quite the same. So they don't expect quite much from this third quarter. And the main hope lies in the fourth quarter when the high season starts again. And for our topic remains as mint, because in the third quarter outlook is still decent, and also its earnings will be mainly driven by its lower interest costs. And also we have a slightly less positive view on the interest expense decrease, but still we think the lower interest costs will be quite substantial and will be able to allow them to show a strong year-on-year growth. So that's why if we are ranking the hotel sector, that will be the first one will be Mint, and then it's being followed by Centel. For Centel, what we like about them is that they're still able to maintain their RevPAR to be quite flat year-on-year, and it's being strongly contributed by the hotels in the up countries and also in Japan. And then the third ranking would be Erawan and AWC. I think these both are have quite the same picture, because their RevPAR is expected to drop around like high single digit year-on-year, because the hotel compositions are very much concentrated in Bangkok and Pattaya, and also in Phuket, where those are like the main cities where Chinese loves to travel. So yeah, that's it for hotel. And also I'll go have a short update on AOT. Just
sorry, maybe I just ask you some
okay.
couple questions first. So your topic is mains, lower interest costs, etc. But is it because it's less dependent on domestic as well?
Yeah, it is. But still, if we are talking about the operational RevPAR, it's also down year-on-year quite a bit in Europe, because mainly due to last year's high base, which is caused by like the Taylor Swift concert, the Euro 24, which drove up the base of the RevPAR to be quite high. But still, the year-on-year drop is not very substantial. It's still quite okay. And also their performance in the Maldives is also very strong. So yeah, the top line could be pressured a little, but still the drop in the interest cost is much more substantial, given how dovish the ECB is.
So overall for this sector, right, it's just the whole sector has this same problem
Yeah.
with softer RevPAR, still weak, or
Yeah.
unexciting tourist spending or tourist arrivals. Still the
Yeah.
same, right? Still
Yeah,
the
it's
same
still the
story.
same.
Okay,
The
all
same
right,
as
got
the
it.
second quarter.
Mm,
And also
okay.
everyone is like waiting for the fourth quarter when high season comes, and also many of the renovations will be back, like for example, like Mint, where they renovate like 40 to 50% of their revenue of their hotels in Thailand. So yeah, it will be back in November, I guess. Yeah, just to be ready for like the peak festive weeks. Yep.
Okay. Okay, AOT.
Okay. For AOT, just some short updates. So we still need to monitor the outcome of the studies to find the conclusion with King Power in this upcoming mid-September. So yeah, we'll see how it turns out. I think that there should be a special meeting by the AOT management to disclose the results of the studies. And also, yeah, we'll keep you updated on that. And also the fourth quarter outlook should be showing a Q-on-Q growth, but still drop year-on-year. And key drivers are from a slightly better recovery of the passengers traffic, as previously mentioned about the Chinese. But yeah, the outlook should be go in line with the hotels. So nothing exciting, just some passengers recovery. And also the next development that we should monitor is that the PSC conclusion, which should be reached in the middle of October. Yeah, and as you may have seen on the news, there's like the figures being thrown out, like 100 baht per head of PSC increase. That is not accurate, because the management says that no, we have not disclosed to anyone outside of the organization. So yeah, that's just baseless.
I see.
Sorry,
Okay.
baseless news.
All right. Okay.
Yeah,
Thanks for the update. Okay.
That's it for the AOT.
Okay. Thank you.
All right. I think that's it from our part.
Yeah, I think we all done story.
Okay.
Yeah.
All right. Thanks, everyone.
Thank you.
Thanks.
Bye-bye.
Bye.
Thank you,ค่ะ
Have a good week ahead. Bye.
Bye.
Thank you.
Bye.